Hey guys, what's going on? Kunal here, Bulls on Wall Street. Want to talk to you guys about something that I think is really important in trading that, frankly, we forget to do sometimes. When we're trading, I want to talk about a trade I did today in PCG. So this PCG warns today of potential significant liabilities tied to Campfire, draws down revolving credit. So basically, like this company, right, they're involved in some way. They're the utility company that's centered around the California forest fires. Obviously, a lot of people died. It's a really tragic thing. And it looks like some news came out yesterday that, they had saw some sparks on some of their lines or something. They didn't really do anything about it, whatever. But what I want to talk to you about is when you get like a fast moving stock, something that's got fresh news out like that, of course we want to short it, right? Because it's gapping down. It's got this news out. We've read the news and it's like, oh shit, man, this is really bad, right? And we got to wait for our pattern to emerge. But I made a classic mistake in this pattern that really kind of limited my profits and actually got me down on the trade rather than making like 5-10 grand, which is probably what I should have made if I had handled it right. I ended up $2,000 for the day, but only $1,500 on this PCG, and I was actually down on the stock quite a bit because I broke in a rule that is really important, like when you're trading. So when you're trading and you get something that's like really volatile like this, so this is the chart for PCG. This is a 5-minute chart, right? So we were talking about this pre-market in our YouTube live show that we do every single day. I really appreciate you guys coming in and watching me every day. I feel like we're building a really good community. And we were talking about this, right? How this stock is gapping down on some bad news. Let's see what happens. Well, as the stock gapped down, I wanted to short it only on a spike. So normally, like if a stock gaps down, we look for an ORB sometimes. But if the short sale restriction's on because it's gapping down a lot, oftentimes it's got to kind of spike towards that 9 EMA. So, the first candle, like this stock spiked up, spiked down, and then it spiked all the way back up to 29.33. So it's like a $2 spike. And I made a classic mistake on this, which was, as this thing was kind of hovering at the VWAP, I ended up shorting like 1,500 shares right at 28 as it was kind of busting under the VWAP. And it was way too early of a trade, and I had too much size on it in accordance to where the next level resistance would have been, which is the 9 EMA. So 9 EMA, well, at the time when I shorted, is all the way up here, right? So like I would have had a lot of airspace of risk. So the pattern's not tight, and so going full boat, right, like with a heavy position size is just too much risk. So what ends up happening is this stock comes down like 50 cents. Some have like $750 on it, nothing special yet. But I'm like thinking, okay, maybe it's going to break down, and then boom, it squeezes the short sale restrictions on it, and it ends up having a squeeze here right into that 9 EMA. And I ended up taking my stop as it kind of just broke above these candles over here, and so I ended up losing about 25 cents on it, which would be like $500, give or take $450. But the mistake I made on it was that I had too much size, right? And so if you're going to be early in the trade because you have this feeling it's going to go down and you're waiting for the pattern, it's important to really scale in, because what ended up happening is I had too much size on it. And so then when it actually popped, rather than like adding more shares and scaling into my trade properly, because it's such a wild mover, I ended up having to cover for minus 25 cents, which is nothing on a stock that's moving around $5-10. Think about this. If a stock is going to move around $5-10, you can't have a 25-cent stop. But the reason you use the 25-cent stop is because I had too many shares, right? And so there's the dichotomy there that we have to fix. So how do you fix it? Well, if your stop needs to be looser, you have to have smaller position size, right? And then add to the trade as it starts to prove itself. And then you can kind of see what happened here. It's like it popped up for like 20 minutes, and then boom, big giant MPC candle. We call that the mega penis candle, right? Where you just get this big flush. Now I can't chase this, right? But now it's broke under the VWAP and it's getting ready for that opening range breakdown. And so it's on my watch. And then of course, I can't chase it down here. So, what I do is I just wait. So as it started to hang out here and to tap back into the VWAP, I shorted 1,000 shares this time. I shorted a little bit smaller because, I was down on the day because of this stock, and I want to protect my daily risk on my overall account along with my individual trade. And so I went in a little bit smaller, and then this thing ends up working out just the way, we thought. And so, I ended up making a classic mistake of just kind of blowing some of my capital, but also my mental capital by being early in the trade. And then what happened was I kind of took my eye off of it because I had moved on to other stuff. And then we got this MPC, and then I was like, oh shit, right? I just missed the crack, and now I got to kind of chase it back down a little bit as it sets up. And so just something to always kind of keep mind of. I was still positive on the next trade, a couple $1,000s, but I finished in the hole because of a bad entry. And then, the one thing to really remember, and so why this should have been a much bigger trade, is obviously I had a really good entry right around 28 again, and this thing got down to 22, right? And so I left a lot of money on the table by breaking one simple rule, right? When a stock starts to trend, you want to really follow it along the 9 EMA, but then also look for spots to add more shares. And so you can see here, like at 27, you had a nice support build here with the 9 EMA on top of it. I should have doubled up right here at this 27 and caught a really big flush and tried to turn this into a much bigger trade because it had proved itself at that point. See, once it breaks under the VWAP and starts to go, it's proving itself to you, right? Stocks under the VWAP are very bearish. And so now the money's working in your favor. You can add to your position as long as new patterns emerge, and then you can go in for a much bigger trade. And that was really where I made my mistake. My secondary mistake was even more costly, right? Not adding more shares as the trade starts to materialize and show, and kind of turning something that was going to be a couple $1,000 into something that's much bigger, because you get these kind of trenders, right? Only a couple times a week. And so when you get in one, you have to recognize it, use your tools like trends and EMAs to really follow that thing down. I should have been holding this thing down at least till it started getting this extended down here. Here it's really orderly, so you can just hold it down. But once it starts to get kind of parabolic like that, you definitely want to start covering off into it. I covered mine, all my shares like in the low 26s, I believe. So that's just something, like I was early on it, right? I was like, yeah, man, I'm up now. I'm going to be done for the day, but I needed to be adding to it. I could have still covered some at 26, but I should have added more at 27. So word to wise to summarize, your first entry is important. If it's slightly off and risk is high because the pattern's not tight, add in a starter position, and then add as the trade starts to emerge. And then the second lesson is use your moving averages and the power of the trend to capture as much gain as you can. See, a lot of times people say in trading, you don't go broke from taking profits, right? You ever hear that term? Well, it's kind of a misnomer. I don't believe in that term, because if you made $100 on a trade, but you left 10,000 on the table, is that really a good trade just because you made $100? You're going to be happy with that? No. Our job as traders is to trade that stock and that pattern to the best of its ability and extract as much as we can out of it according to our trade plan and our trade rules. Remember that for as long as you trade, it's going to put you in a really good spot. So hopefully that helps. I'll see a lot of you guys on November 20th. As you know, we're doing a 2-day webinar. I'm going to be talking about bear market trading tactics. As you guys probably have seen, this market's just been getting smoked all over the place. How the heck do you trade it when the market gaps up and we're taught to, right, chase strength as we have the last, right, couple years, to fading strength, right? You have to almost completely re-engineer how you think about trading, but there's some simple tools and tactics that we use every single day to go and hit the ground running in this type of market. So I look forward to seeing you guys all there. I'll make sure to put a link in the comments or the subject or whatever they call it on YouTube. And guys, if you're liking the video, give me a thumbs up or something like that. Tell your friends about me. Just kidding. I love you guys, and I'll see you on November 20th. And I'll go back to making some regular videos because we've been doing the YouTube live so much. I've been kind of a little bit complacent, like I am kind of making a video every day, but I'll get back to making some more trading related videos and get this ball rolling. Guys, let's end this week. So it's November 14th. We have literally 6 weeks to go out and hit our 2018 goals and more importantly, hit the ground running for 2019, which is so important. Let's do that. Guys, let me know any comments or questions. As always, you can email me at canal@bullson.ws. Look forward to hearing from you guys. Take care.